Jesse, thank you so much for joining us today.
Hey, thanks for having me.
All right. Now, last time we had you on, we were talking about the Federal Reserve's tightening of monetary policy and how you thought that would lead to stocks falling significantly. Now, it seems like we've actually seen more of that, more tightening, and in the last couple of weeks, we've seen in the United States and around the world the stock market's tanking. What is your perspective on what is happening right now?
Well, I've been saying since, probably about a year now, when I first started noticing a big cluster of Hindenburg omens last November, December, that I think, that was the blow off, and we're in the midst of a major topping process right now in the stock market. In fact, I think I wrote an article about it a couple of weeks ago. On the New York Stock Exchange, we had 11 Hindenburg omens in a row after Labor Day last month. And that's never happened before. So there were signs that there was a major dispersion going on in the markets. And it's coming to people's attention now that we're seeing stocks like the home builders and the automakers and the bank stocks and industrials and a lot of these companies that are really economically sensitive. We're seeing these stocks down 30-40% in a lot of cases. And so far, the S&P has held up. But I do believe we're just in the midst of a major topping process right now.
Hey, Jesse, if you don't mind, for listeners out there, just giving them a little bit of background on the Hindenburg phenomenon that you're describing.
Sure. Yeah, it's basically when you're at new highs and the major indexes are within 5% or something like that. Mm-hmm. And then you see not only a bunch of new highs within the index, but a lot of new lows also. Mm-hmm. And so it's something like when new highs and new lows both make up more than 2% of the underlying components or something like that. I'm at the top of my head not
sure.
familiar with the exact. But essentially it's a sign of that widening dispersion, right? When you have a really good, healthy uptrend and new highs, you should not be seeing a ton of new lows. And so, the Hindenburg omen was developed to kind of be a signal as a potential crash indicator. And, I've always thought that one omen is, not always a great indicator of that. But when I look at omens over time, and so, over a period of 10 days or a month. In fact, over the last month, we've seen 24 Hindenburg omens triggered across the NYSE and the NASDAQ. And just to, put that in perspective, at the 2000 top and the 2007 top, we saw about 14, 15 omens trigger in a month's time. We've now seen 24 over the past month. So to me, the signs of that breadth dispersion underneath the surface of the market are pretty darn clear.
Yeah. I mean, most people going about their day-to-day business are just looking to see the S&P 500 number, maybe even the Dow if they don't understand how ridiculous that composite is. I mean, that's all they're looking at. They probably aren't even going in to look at their shares as far as individually day-to-day. So it's an interesting point that you're putting out there. I wanted to kind of move back a little bit. Last time we spoke, it was in July, I think July 20th. We had talked a little bit about Netflix and the situation that it was in. It's kind of treaded water, gone sideways, had some issues. It looks like some bad headlines recently. But I wanted to swing back towards something you've been writing about a lot. I think you've done a couple blogs on it, the FANG versus BANG stock phenomenon. You described the fact that there's more ETFs now traded than individual stocks in the S&P 500, the rise of passive investing, how that kind of coincides with investment trusts in the 20s. I wanted to talk to you a little bit about, because I found the point interesting, the fact that passive ETFs, they have a lot of exposure to FANGs and not so much to the BANGs. And so maybe you could talk about a little bit about that study that you did, and how maybe that's keeping gold miners in a place where they are at the moment.
Yeah, I think that really this is another speculative mania in financial assets. The bond market is crazy, has been for a while, but the stock market too. I've talked about it as, an everything bubble where prices of all financial assets have gone, to ridiculous heights again. And I think that's driven by this passive investing mania. And I call it a mania because I think people believe that if I just put money into the indexes, I'll make money over time, regardless of the price that I pay, regardless of earnings growth, regardless of any of these fundamentals. And, that's, kind of mania type thinking, right? Only during a mania can you believe that no matter what price I pay, I'm going to make good money over the next 10 years. And that's what people believe. And so it's the only money that's been flowing into them in the markets has been flowing in through these passive products. And so, the number of ETFs out there have exploded, and the assets, it's in the, trillions of dollars, $4-5 trillion in ETFs now. And that's been driving the markets. If you look at the FANG stocks, the average FANG stock has something like 150 ETFs that are heavily exposed to a FANG stock. Oh. And so money flows into these ETFs, and it goes into the biggest names, Facebook, Amazon, Netflix, Google. Mm-hmm. I throw Apple and Nvidia in there sometimes too because they've also benefited. Mm-hmm. And so I thought it would be interesting to look at the BANG stocks, which are the four big gold miners. I look at Barrick, Agnico Eagle, Newmont, and Goldcorp, and see what does the ETF exposure look like here, and maybe that would help explain why the stocks have done poorly. In recent years. Obviously, the gold price has come down from 2011, but the mining stocks have done, very poorly relative to the metal. And, the performance relative, you look at a ratio of the mining stocks to the S&P, and they're about as cheap as they've ever been. Right. And you look at, Newmont has some exposure to ETFs, but outside of that, there's literally you could count them on one hand, the number of ETFs that own, Goldcorp, Agnico, and Barrick. And to me, that's just a sign that these things have been left for dead. And that, there's really only one way for them to go, which is, everybody who's wanted to sell them has sold them. And, the only way this, ownership can go is one direction. It's towards, people having to buy more of these things. So, I called them the greatest anti-passive trade. That if you think passive is a mania and it's going to unwind, money's going to flow into gold and the miners. On the flip side of that trade, and the ETF ownership there kind of bears that out.
Yeah.
Now, looking at the macro picture, as we're talking about this maybe stock crash that's going to happen in the near future. Where do you see the money going? You're saying maybe precious metals. I mean, there's a lot of different sectors, right? We're seeing also rates rise. We're seeing the 10-year Treasury yield at about a 5-year high. Where there's a lot of money out there. If we look at these three sectors, stocks, bonds, and precious metals, where is the money going to flow?
Well, I think, that's a very interesting question, and it's, impossible to predict, but I'm operating under the guise that economic growth is slowing amidst rising inflation. Over the past year and a half, Alan Greenspan has been saying, we are headed for stagflation. And, you can think whatever you want about Alan Greenspan, the problems he's caused in the economy and the boom-bust cycle in the markets. He's still, very well versed in the economy and what's driving it. And I do think we're actually probably on the verge of stagflation right now if we're not already in it. I mean, you look at, auto sales and home sales are falling, but, wage growth is still rising and costs are rising. And a lot of this is a function of not just end of cycle type of pressures, inflation pressures. I think there's, these secular forces of inflation that are at work too, which is deglobalization, bringing back, jobs from overseas is, a massive inflationary impulse. Globalization was probably the most disinflationary force of the past several decades, and so a reversal of that is bringing inflation back in a way that we haven't seen for a long, long time. And then you see, the fiscal, policies that are going on, a massive tax cut. Trump's talking about another tax cut. We're talking about infrastructure spending. So I'm looking at this economic slowdown that we're seeing right now as more of a stagflationary type of episode, different from the past two recessions that we've seen, which are more kind of deflation. We didn't see actual deflation, but they were kind of a deflationary effect. And so I'm operating under the guise that, this is not likely to be another one of those. We're more likely to see a rising inflation and slowing real growth type of phenomenon, which would be very bad for financial assets because it means rising interest rates. And the only way to really protect yourself is to focus on real assets, and namely precious metals.
Right. I mean, the last time we had a situation of stagflation that you're describing, it's well before most of us were alive, or some of us were just born, right? So we're talking 1970s. That was the last time we had a situation where interest rates were rising, but yet, obviously, all the things that you discussed, inflation was very, very high. Jesse, I wanted to talk and go back another blog that you'd recently written about how you go about discovering trends. I went through your Twitter feed before we got on the call today. It's a great Twitter feed. Your Twitter feed is very wide in the stuff that you read every day. If you could explain to your readers or to the listeners your process, what you do, like as far as keeping up with trends and how thorough that can be.
Sure. I wrote a post about this recently because I interviewed my friend Mark Yusko a couple times over the past year, and he introduced me a book called The Dow Jones Averages. And the guy who wrote that book is a real fascinating guy, has a unique look at the markets, and he talks about it's not just, this book or this company. A lot of the most successful investors I've met and I've known really spend a ton of time digging the developments within their industry. Fred Hickey, I also interviewed recently, and he stays on top of, the tech world better than anybody I've ever come across, because through his contacts, but also just through reading, real specific kind of sector type semiconductor journals and these types of things. And so that's what I try and kind of do on a macro scale, is pay attention to what are the major themes that are developing, in the financial markets. And the way I do that is just kind of by trying to cover the widest area of news and things. It's not just Wall Street Journal, Financial Times. It's, Wired Magazine. It's, just a wide variety of different things to see, what is really developing, what kind of narratives are developing out there. And to me, that helps me pay attention to kind of things like this stagflationary idea, right? And, the backlash against big tech is another one I've been writing about for about a year and a half now. And that one's still developing and is still growing. So, I spend a few hours every morning just reading through a ton of stuff to try and put together these types of developing narratives.
By the way, kudos on that podcast you did with Fred Hickey. That's a really good one. It's like an hour and 10 minutes. I think it's just a month or so old. So listeners out there, if you want to listen to that podcast, it's great. I mean, the process that Fred Hickey talked about going through to do what he does in the semiconductor world is pretty amazing, the amount of work he puts in. And then he also has reasons why he buys gold mining shares as well, and why he's a bull for gold in the long term. So really good interview, and kudos to you, Jesse. It was really good.
Yeah, thanks. Fred's a brilliant guy.
Yeah.
Now, moving forward here, you were talking, Jesse, about how we're going to see a lot of stagflation coming in the future. As James was talking about, a lot of us don't remember this when it happened in the 70s. What, for like the average person, how is that going to impact their lives?
Well, there's to me, I just keep finding, talk about these themes or narratives that I'm on. I keep finding parallels with the late 60s to the current period. And if you look at actually just, I've tweeted this chart a couple of times. The Fed removed accommodative from the language recently, and I couldn't resist. I had to say, tweet that, this is the most accommodative Fed policy since the late 1960s. I mean, we've never seen it before, where the Fed funds rate is essentially negative still in real terms, and we're at 3.7% unemployment. It's absolutely insane. It's still massively accommodative. And so, Trump criticizing the Fed is another one that, dates back to that, 60s, between, Gerald Ford and Richard Nixon, both pressuring different Fed heads to keep interest rates low. You see Trump doing the same thing now with Jay Powell. And so, there's just a lot of parallels between those times, today and back then. And, essentially what we saw then was, stock market peaked in, late 60s. We saw a little bear market in the late 60s, but the 73, 74 bear market was the one where the markets really woke up to inflation, and that inflation was out of control, and the Fed was behind the curve. And so I see something similar today, where to me it's pretty obvious the Fed is behind the curve. The tightening they've already done is slowing down the economy. So they're in a real, I call it, it's a horrible decision the Fed has to make, and it's a decision between the devil and the deep blue sea. You either choose the devil, which is, okay, we're going to have to raise interest rates to keep inflation under control. But we risk undoing all the stuff that we did to boost financial markets over the last 10 years. But that's, at least we know we're going to keep inflation in check. The deep blue sea is the scenario where they say, okay, we want to try and keep propping up the markets. We don't want to raise interest rates too fast. That's where you get inflation that runs out of control. And, it's neither scenario is a good thing for the economy or the markets. But I think the Fed understands that a hyperinflationary scenario is something, they have to guard against that above all else. And so they cannot accept the deep blue sea, which is inflation running out of control. They have to tighten policy, and even if the economy is slowing, even if the markets roll over. And so this is where you start talking about potentially the expiration of the Fed put, where inflation is going to prohibit the Fed from coming in and being able to try and save the markets, because they're going to have to keep tightening policy, or at least, at the very least, they're not going to be able to cut interest rates or re-implement QE, because inflationary pressures are still there. So to me, that's what investors should be thinking about, is that for the first time in, since 1987 or, before that, the Fed put might not be there anymore.
Hey, Jesse, do you do much studying as far as the U.S. dollar strength versus other currencies? I mean, there's people out there, depending on which camp you talk to, obviously some people are more bearish or bullish in the medium term, say the next year or two. There's a big camp out there that does think that the U.S. dollar, for whatever geopolitical reasons, is going to start strengthening even further than it's been. Obviously it had strength in 2015, and it's kind of been sideways for the last couple of years. But there are some people out there who think in the coming years there may be another squeeze for further dollar demand. And so is there possibly one more pop for the U.S. dollar? Do you foresee coming?
I mean, there could be in the short run. I try and simplify the currency question. I mean, there's two things that I look at in terms of the dollar. One is just the federal deficit. The dollar and the deficit are highly correlated over longer periods of time. The deficit is widening. That's bearish fundamentally for the dollar. And, if we get a recession, the deficit's going to blow out. We're going to see $2 trillion in the deficit, and the dollar's just going to absolutely, have a ton of pressure on it. But, to go along with that, that's kind of the fundamental side. The sentiment side of it is, traders are so bullish on the dollar, and bearish euros, bearish yen, that you look at the Commitment of Traders report, and, the people are massively long the dollar right now. Mm-hmm. So that tells me that both fundamentals and sentiment from a contrarian standpoint are bearish for the dollar, and that yes, it could, who knows, it could pop in the short run. But longer term, over the next year, 1 to 3 years, the dollar's headed lower. I think we're in the midst of a dollar bear market. This rally that we've seen was driven a lot by just the repatriation of funds by corporations. There's not a lot of fundamental reasons why the dollar should be rallying. And if it comes back to the Fed too, and the Fed's going to have to keep raising, but also Bank of Japan and ECB are going to be, tightening too. Mm-hmm. So, I think that the Fed might be tightening less in relation to those central banks over the next couple of years, which should also be, bearish for the dollar. So, but the other thing to think about in terms of the dollar, Stan Druckenmiller recently gave an interview to Real Vision that was pretty interesting. He talked about in the late 2000s, one of the reasons he became very bearish on the stock market was the dollar, interest rates, and oil prices were all rising. And in the past, that had been a very bearish thing for corporate earnings. Well, what's been going on over the last year? The dollar, interest rates, and oil prices have all been rising. Yeah. And so I think that's what the market's starting to try and reckon with a little bit here, is that earnings growth over the next 12 months is going to really slow down, if not go negative.
Thanks for that.
Now, in one of your recent articles, Jesse, you were talking about how many investors are relying really on kind of a one-dimensional view, as you said, of investing. They're really essentially just momentum traders. They're only following current trends. So with that kind of habit of a lot of traders, how is that going to impact like the dynamics of the market going forward? If we start to see, as we've been seeing over the last couple of weeks, the stock market fall, people, it seems like, following your view, it's going to be fear on, right? It's going to be a big fear trade right now.
Yeah, I think I write that because people try and make a point about the markets, and well, they're not that expensive at 22 times earnings. And when you actually think about, the valuations of the stock market, well, 22 times earnings is actually historically pretty high, but they're not thinking about what is underlying that. It's the highest profit margins in history. So if profit margins normalize, you're talking about a 40-50 PE currently. So people just look at these things in isolation and don't think about, what's underlying the PE ratio. But I think, in terms of one-dimensional strategies, passive investing is essentially just momentum investing. And I think a lot of those people are just momentum investors. And then maybe another one-dimensional strategy that's real popular today is just trend following. And so you have these two one-dimensional strategies that are very popular, momentum and trend following. And if we run out of momentum and the trend reverses lower, in fact, we're trading below the 200-day moving average right now on the S&P. So by a lot of people's, a lot of trend followers, standards, Paul Tudor Jones standard, the S&P is now in a downtrend. So if you get trend followers reversing and you get momentum traders go, oh no, the momentum's not working to the upside anymore. And the tell for that is the FANG stocks. Once the FANG stocks start outperforming to the downside, then I think you'll start to see these trades reverse themselves, where momentum investors try and liquidate, trend followers try and liquidate at the same time. And, to me, that one of the biggest signals of how much risk is out there in the markets is just the net free credits at brokerage firms right now. And it's about 3 times bigger than it was at the peak of the dot-com mania. I mean, another way to look at it is just margin debt, leverage being used in the markets. And it's so massive today that I look at that as what is the potential forced selling once the market turns south? And the potential forced selling for margin calls or whatnot is as big as anything we've seen. And so, the risk once this thing reverses is much bigger than most people appreciate currently.
I saw an older colleague of mine who just did a vlog, basically a video blog on this topic, and he was opening a Charles Schwab account and stating that they basically automated margin account agreements, and so there's like very little risk. You can click and learn about the risk if you're going to read a 50-page diatribe, but flat out you just press a button and margin's yours. And Lord, these people, they have no idea about what they're up against if this thing goes reverses on them. So I totally agree. The margin has gotten crazy. One thing, Jesse, I wanted to throw out there, and I go to your blog all the time. I check out your work. I've never gotten to actually subscribe for your service, but I wanted you to tell me about it. What is in your service, your yearly service that you sell on your website?
Yeah, I mean, I write a weekly market comment that I try and write a much more expansive view of some of these trends that I'm paying attention to. So, we talked about stagflation last weekend. I wrote a much more detailed discussion of the signs of these things and how they're playing out now. So that's part of it, but really, where I feel like if I have any expertise at all in the markets, it's in individual stocks. I mean, the macro stuff is, I think, something we've been forced to pay attention to just based on what central banks have been doing around the world in the past 10 years. But it's the micro stuff where is my bread and butter. And so I look for individual stocks where I see, and a lot of the times these are stocks like the bank stocks, which are outside of the purview of the major indexes, outside of the purview of passive investing, where you might find something that's cheap that technically looks interesting, and I see some very compelling insider activity. So CEO, CFO, just buying a ton of stock. And on the reverse side too, I just wrote a recent thing about Salesforce.com. Technically looked like it was potentially rolling over. The cash flow statement had a couple of red flags. And then I saw some top executives, several of them, chief accounting officer, chief financial officer included, both selling 60, 70, 80% of their shares in the company, which all kind of, to me, goes, okay, I need to sit up and take notice. This looks pretty darn bearish. So those are the types of things I look for and write about on the micro side.
Cool. Thank you for that.
All right. Well, Jesse Felder, thank you so much for joining us.